Welcome everyone to the ESRS 2.0 webinar. We're going to be taking you through the implications for your double materiality assessment with the new amended ESRS standards. Bear with us and we're going to kind of take you through that, keeping in mind that these are amended standards that are yet to be finalized. So keep that in mind, please. With that, very, very quickly, let's just introduce ourselves. My name is Shivani Rajpal. I'm the CEO of Earth Academy. Over the last 17 years, I've been helping companies, governments, etc., with capacity building on sustainability and sustainability reporting. I've worked before Earth Academy, I've worked for GRI for 12 years, where I was the Director of Training and Services. And there I basically helped, again, organizations and governments with the implementation of GRI standards. Overall, I'm an expert in the different standards like GRI, of course, like IFRS, TCFD, and CSRD. And I'm very, very happy to have my co-host, my co-trainer with me today, Lorinda Niemeyer, who's also a partner at Earth Academy, to give and co-facilitate this webinar with me. So, Lorinda, over to you for your quick introduction.
Great. Thank you, Shivani. It's great to see everybody this morning, this afternoon. Hello from wherever you're coming from. I'm Lorinda Niemeyer. As Shivani said, I'm a partner here at Earth Academy. I bring about 3 decades of experience across sustainability and strategy, beginning as an environmental regulator, spent most of my time in consulting, and now I'm head of sustainability for a large financial institution. And we're going into our 3rd year of ESRS/CSRD reporting, first year being voluntary. So we're part of wave 1, and part of what I will want to do today is bring some of that firsthand experience to life as we go through the materials today.
Great. Thank you so much, Lorinda. And we are going to have a separate Q&A section at the end towards the last 15 minutes or so. But it would really be helpful for us to kind of keep receiving the questions as we go along. So please use the chat button, send the questions to me, to Shivani, and I will collect those questions. I'll group those questions, and then we will both, Lorinda and I, will answer these questions towards the end of the webinar. But please do keep sending those questions alongside. So, well, what's better to start the webinar with a quick kind of understanding of where you are. So let's begin with a quick poll. So over to you with the first poll on how is the double materiality assessment seen in your organization today? Is it seen as a strategic filter for reporting and decision, or is it a helpful reporting tool or a compliance exercise, or you haven't done that yet? So there are polls running. I can see we have about 50%, close to 60% now. And you can't see that yet, but I'm going to share the results to show you how it's actually looking. We have about 75% responded. I'm just going to give a second or two. You're also kind of getting new participants, so it is stuck on 75% right now. But let me just end the poll and start sharing the results to kind of just keep in mind the time as well. So here, I hope you can see the results now. Most of you, so 73% of the participants responded to this poll, where most of you said that it is a strategic filter for reporting and decision making. About 34% of you said that. A compliance exercise was said by about 29%. 22% have not actually been there yet. They haven't done the DMA yet. And 14% said a helpful reporting tool. So that's really great. Thank you so much for these responses. They're really helpful for us to kind of just understand where you are at this point in time. So from that point of view, it's also very encouraging that many of you do see that as a strategic filter for reporting and decision making. But let's just kind of see how the amended ESRSs bring all that flavor into the ESRSs and renew it from that perspective. So where are we at this point in time? We had our ESRSs published in 2023. We had the Wave 1 reporters who used the financial year data for 2024 and reported the first wave reports in the year 2025. In 2025, Omnibus was announced. And thereafter, we also had kind of the whole public comment period and exposure draft, etc., and came up with the draft amended ESRSs from EFRAG. That was already in November 2025. And now we're basically here in 2026, where we are looking at these amended ESRSs drafts. And I keep on repeating the word draft because that's exactly what they are at this point in time. And the expectation of the finalized amended ESRSs are kind of expected to come around mid 2026 or sometime like that. After that, the adoption by the different countries. So we are where we are at this point in time, but at the same time, the reality doesn't change. The companies are expected to continue reporting, and especially Wave 1 reporters have a lot kind of riding on for this. So that's kind of where we are at this point in time. But then, of course, Wave 2 reporters have to be prepared for this. So you can't kind of just drop the ball. You have to report on the 2027 financial year data to report to come up with the report by 2028. So a lot of thinking needs to go over there. And then again, of course, non-EU parent companies have to report the following year. So that's kind of where we are at this point in time. But that also means that all of the time that we are kind of getting at this point in time is all a gift that we can take to make our DMA and make our ESRS report stronger. So post-omnibus ESRS, the amended ESRSs, what do they actually bring? One of the biggest criticisms that the original ESRSs had was the volume, that it said companies felt that they were asked to disclose everything, everywhere, all at once in their huge report. The amended ESRSs, they directly address that, they respond to that, they basically reduce the mandatory data points to about 60%. But that comes with a caveat. This does not mean that the reporting is light. It actually means that the baseline is smaller, but it gets more rigorous. And we're going to come to that in just a bit. And for the first time, ESRS also explicitly acknowledges that not all the information is equally important and also not feasible to obtain. So the amended ESRSs also they introduce a clearer undue cost or effort relief. And this is very closely linked to what IFRS is also used to doing and also what financial reports have. And so this undue cost and effort, we're going to explain that to you in a little bit. But that also means that materiality assessment also gets that kind of relief of undue cost and effort. So anything that you include in your report needs to now be looked at from the point of view of your cost and effort. And if that's disproportionate to the benefit for the users, then you're allowed not to include that information and explain that reasoning. And material information is the filter for all the disclosures. That is kind of really theoretically what has been introduced or reintroduced in this amended ESRSs. This basically means that you'd have less boilerplate information or disclosures. There would be greater focus on impacts, risks, and opportunities that would influence the decisions of the users of the report. Now, while we look at how it kind of reduces the volume, it clearly increases accountability and judgment for the users. So amended ESRSs, they hold the company much more accountable for the judgments that you make in your reported information. They basically take the approach of fair presentation. Again, a fair presentation approach or principle is also very closely aligned to the IFRS's principle as well. And what that means is that when you include the reported information, that has to be complete, that has to be neutral, and that has to be balanced. So a lot of kind of judgment and transparency is put it kind of takes a much higher bar than before. Materiality, of course, has quite a high stake in this. It was always important, it was always central, but in the amended ESRSs, it becomes the backbone of the entire report, with the expectation that materiality would lead to a clear articulation of your material impacts, risks, and opportunities, which would then help the users of the report, the readers of the report, to take clear decisions related to that. ESRS also focuses kind of really thinking about your material I's, R's, O's that would be helpful for the decision making of the users. It also focuses back on the entity specific metrics, which become even more important because now your report readers are going to be dependent on those IROs for decision making, which was always kind of what was the aim of the ESRS report, but now it's more explicitly mentioned. So whenever you're doing your materiality assessment, entity-specific metrics become even more important. And there's a huge connection to the financial data and the story that comes back in the amended ESRSs. So in short, if you kind of look at what has been added, what has been changed, what has been reduced, we can kind of conclude that less data does not mean less responsibility. In fact, it means more judgment and more accountability. So that kind of really thinking has to be kept in mind when doing the revised materiality for ESRS. Now, we talked about fair presentation a little bit, but I think this is quite important to just take a moment and talk a little bit further about because this term can be easily misunderstood. This is a move to fair presentation framework, which is also in line or aligns with the IFRS principles. It is not a technical tweak. It is really a mindset change because really when you look at the fair presentation, it means that the providers of financial capital and the other users of your report should get your balanced, your complete and accurate picture from your sustainability related impacts, risks, and opportunities. So you need to include all of that information to give that true and fair picture, to be able to reflect how your business operates, to be able to align that with your internal decision making, to explain why those impacts, risks, and opportunities are material. And again, cannot focus more on that, but entity-specific metrics and the connectivity to financial information really have taken on new importance. They're very, very important in the new amended ESRSs. Moving on and continuing kind of to talk a little bit more about materiality, decision usefulness. One of the fundamental shifts is the information materiality, which is now the filter for every single disclosure, even for ESRS 2. So where ESRS 2 initially in the older version of ESRS was always supposed to be material for all organizations, that is not the case anymore. All disclosures would now have to go through materiality filter. So in the past, a lot of organizations would kind of use that boilerplate information. That approach would no longer work anymore. If you basically disclose, and it comes back to why is it actually important to include that information and why is it important to not include immaterial information as well. If you disclose immaterial information, that obscures what truly matters. And so it comes back to looking at the information from the lens of, does it provide material decision useful information for your particular material impacts, risks, and opportunities, including the ones that are entity specific for your organization? Could there be anything else that your users would need to know for kind of making those important decisions? So it's really important to understand what is the definition of materiality or material and decision useful information. It is information whose absence would basically change how the readers make decisions based on the reports that they're reading. So these readers are not just the primary users of general purpose financial reports, they're also they're basically also the other stakeholders. So they're providers of capital, they're other stakeholders. All of these combined are your affected stakeholders who are going to be interested in making decisions based on the sustainability report that you publish. So that's kind of really that puts a higher stakes on materiality and decision useful information. Now let's look at updated standards just before we go a little bit deeper into different areas of what's changed. Let's also look at the structure that has not really changed. So we still have two cross-cutting standards, ESRS 1 and ESRS 2. Then we still have the 10 topical standards as such. So those topical standards by their names haven't changed. But when you actually look underneath, they have reduced data points. They have the sub topics have been taken out. They are now divided under the topics and the subtopics underneath. And materiality or material information remains the filter for all types of data points. We're going to go into more details. But we just kind of wanted to bring this particular structure back into place and just to kind of give you a little bit of an idea of what's changed and how the updated standards look. So look-wise, they do remain like this. Again, before moving further to kind of look at the other details of the standards, let's do a fun fact poll where this is the second poll and the last poll for this webinar. What do you think in the amended draft ESRS, which are always required, which kind of disclosures, topics, standards are always required irrespective of the materiality assessment? Is it ESRS 2, even climate change, both of them, or none of them? Can we have the second poll, please? Okay. About 65% participants have responded. So the question is, in the amended draft ESRS, which are always required irrespective of the materiality assessment? We have about 80% of the participants already responded. I'm going to end the poll just for the sake of time. And I'm going to say Lorinda and I, we were kind of thinking of really to have this poll or not, but I'm so glad we had it over here because there's still a lot of misunderstanding behind this. I can see that majority of the participants, about 37% of the participants said both of them. So both ESRS 2 and even climate change remain required standards irrespective of materiality assessment. Many of you said ESRS 2 remains material irrespective of materiality assessment. And again, the third highest has been E1 climate change, and only 16% of the participants said none of the above. And the answer is none of the above. Like I explained very briefly before, and we'll continue to kind of explain that later on as well. The idea is that the new amended standards, they basically have materiality information filter all across the different standards. Where ESRS 2 in the previous version was supposed to be material irrespective of materiality assessment, that has actually changed. That's a big change. That's really an important change to keep in mind. How that in reality is going to be included, that's a different thing to kind of look at, practicalities of that, but theoretically, ESRS 2 also has a materiality filter now. So there is no standard that you use without materiality now. I'm going to close the poll and move on to the structure of the ESRS 2. So this is how ESRS 2 actually looks like. There are few important changes over here already structurally. If you look at it, we still have the basis for preparation. We have the BP1 and BP2 disclosures. We still have the governance and the strategy pillars. But you can see the IRO and the metrics and targets, those pillars have actually been taken out from here. The governance and the strategy pillar that you have over here. There are IRO disclosures that have been moved under the strategy pillar. So there are 4 governance disclosures. There are 3 strategy disclosures and 2 IRO disclosures that sit underneath the strategy pillar. And then the GDR, now that the new pillar that's there, that's basically the MDR disclosures that have actually been moved over there. So the minimum disclosure requirements that we used to have in the previous version of the ESRS now are categorized under the general disclosure requirements, and these are to be reported for all the material impacts, risks and opportunities, together with their associated topics. And these are your GDRP for policies, A for actions, M for metrics, and T for targets. So that's kind of really how structurally ESRS 2 has actually changed. Some of the key takeaways, just to kind of drill a little, or main takeaways from this, is that it has now been streamlined. You can see that it has done to simplify the overall ESRS 2 disclosures. There were a few duplications over there that has actually been taken care of. It has reduced the duplication. New angle of it is that materiality filter also applies to all the disclosures under ESRS 2 as well. So that is important to keep in mind. There has been new guidelines that have been included for financial effects, and you can see that under SPM 3. And there is a required statement of compliance. That's a new type of disclosure that has been added under BP1. So all of these need to be kept in mind. Then we move on. Just to kind of bring everyone on the same page, this is a recap. Some of you may have actually seen that before if you've attended our previous double materiality class, but it's really, really important to understand the core principles behind ESRS framework, which is the double materiality principle. It's basically looking inside out and outside in, looking at it from both angles. Sustainability matter is considered material when it meets the criteria for either impact materiality or financial materiality or both. So that's really, really important. That still stays. That's actually quite integral to the whole process. Impact materiality is where the company looks at the impacts outward on people, on the environment. Financial materiality is where the company considers how sustainability risks and opportunities affect their financial performance of the organization. When you integrate both the perspectives, double materiality ensures that the company provides a comprehensive view of their sustainability matters and in the form of impacts, risks, and opportunities for the organizations that are material for them, so that the report readers can actually take decisions using that reported information. So that's kind of really important to keep in mind when we're looking at double materiality, and that part still stays. Let's look at what theoretically has changed in the double materiality assessment process. There are some very important notable items that have actually changed in the DMA process. First of all, is the approach. Having said that, before I actually go into that, it's important to understand that DMA still stays central to the ESRS reporting. That hasn't changed. But the approach is that there is more explicit allowance for top-down approach. And we'll come to the different approaches that the ESRS can actually go ahead and has actually said you can go ahead and use. Irrespective of that, the outcome is what is expected from there, which is the IROs, which we're going to come back to in just a moment. But the approach explicitly has the allowance for top-down approach now. From topics perspective, topics have been simplified. the topics and matters, now they're called topics. So there's no wording of sustainability matter that you will see. You'll see the wording replaced by topics. That's what you will have all across the standard, which is in line with the other standards as well. The AR16, the long list of those topics, subtopics, and subtopics have now become Appendix A. And the subtopics have been eliminated. Sustainability matters have been eliminated, and subtopics have now all become subtopics. So there's just one layer which is easier for organizations to understand and to implement as well. So that's the change with your topics. Then there have been some clarification on impacts. When you look at actual negative impacts, there is a clarification of how you report on that, whether it's mitigated or unmitigated. There are different ways of reporting on your actual negative impact. There's definition of positive impacts that has been clarified further in ESRS 1. And there have been explanation of assessments and sources that you can actually use as part of your materiality assessment. So those clarifications have been included in your ESRS 1 now. Coming to sources or following on from that is that, again, sources become more from the point of view of reasonable and supportable information without undue cost or effort. So this is a new angle that ESRS has actually taken to say you use those sources where you do not need to put in undue cost or effort, which also means that your direct value chain data may not be as explicitly required if it actually takes undue cost or effort from your organization to include that direct information. So all of that kind of brings, again, it comes with a disclaimer, meaning that all of that brings more judgment and accountability for the organization, meaning that when you're not including something because it's costing you undue effort or it's costing you financially, then you need to explain that and explain what you're doing for that. Coming back to assessment, for the double materiality assessment, initially, there was a lot of time kind of included for quantitative severity determination of all of the impacts, risks, and opportunities that was done by the organizations. Now it has been clarified that for each impact, risk, or opportunity, you do not need to go into the severity from the quantitative perspective. It is possible and okay to include qualitative information for that or do that assessment based on qualitative information. Also, not each of the time horizon need to be looked at from that point of view in more detail. But again, more judgment, more accountability of how you're including your IROs. So that narrative doesn't go anywhere. That narrative becomes even more important, where your organization needs to take accountability and explain how you've actually included your material impacts, risks, and opportunities. And finally, frequency. It has been clarified further that an annual review may not be necessary for your DMA. You could actually do an annual refresh. So these are the main changes, theoretically, what have actually happened with the DMA process. But DMA still remains very strong and integral, and there are some things that actually haven't changed in DMA. And so let's just kind of look at what those things are as well. Materiality has always been the backbone, that stays. It is always in the context of the business model of the organization and the value chain of the organization. You're not kind of really looking at anything before your business model and value chain. That remains an important element. You will always be looking at it from the point of view of understanding how does it affect your stakeholders? What are the stakeholders' decisions going to be affected based on those particular topics, as well as I's, R's, and O's. And your materiality assessment must reflect those things. The outcome of the materiality doesn't change. It still is clearly articulated material impacts, risks, and opportunities, which means that there is a higher scrutiny for the organization to see if there is specific entity or entity specific topics or entity specific I's, R's, and O's that need to be included in the report to clearly explain what is the reality of the organization. Documentation and justification, like I said in the previous slide, they remain key, perhaps even more important because there is a fair presentation approach now, meaning that the organization's accountability really increases from the point of view of getting a clear picture, getting a balanced picture, and a complete picture from those impacts, risks, and opportunities back to the readers of the report. And do remember the connections back to the financial information that becomes even more stronger. And so the overall changes that you see is that it reinforces what DMA was originally intended to do, which is it should be a strategic filter and not really a checklist exercise. So that's kind of really the aim from these amendments that have been done in the DMA. Coming back to approaches, and I know a lot of people would be kind of interested in understanding how do these approaches work and what type of angle has ESRS taken for this. There may be three approaches, top-down, bottom-up, and hybrid. Companies are kind of allowed to use whichever works for them based on their realities as well. So let's start with the top-down approach. This approach is where the organization decides where their possible topics, subtopics are material for them. They use the impacts, risks, and opportunities stemming from those topics or subtopics, and then they articulate those impacts, risks, and opportunities. And again, when you're articulating or determining your impacts, risks, and opportunities from a top-down approach, that not always does it require quantitative analysis. It is now kind of it's fine to include qualitative criteria as well for that. Coming to the hybrid approach that kind of for practical purposes, maybe many organizations would kind of take. This is a top down to align with clearly material topics. So you really look at the list of the material topics, the subtopics, you look at how they align to your business model, to the value chain of the organization. Then you articulate those I's, R's, O's, or you look at those hotspots or the areas of uncertainty from the deeper level, and you kind of really look at how you combine all of those things. And then finally, bottom-up approach, where you are looking at assessing all of the individual impacts, risks, and opportunities. That could really be a long, long list that's based on your logical screening of the topics, of the subtopics. Again, all of these things are possible, combinations possible, no matter what approach you actually take for your final DMA. You have to start with your business model. You cannot ignore your value chain. These are very important starting points. And the end point is always, the outcome is always your material impacts, risks, and opportunities tied back to your organization. So that outcome doesn't change. So here is kind of where what we wanted to show is one of the ways or approaches that we use and we integrate in our training material as well. But again, coming from an ESRS point of view, let's kind of break it down and explain a little bit. So you go from the topic level to the IRO level. Here we are starting from the topic of S1 own workforce, just to keep it simple, because usually S1 own workforce is a common material topic for many organizations. So if we look at that topic, one of the subtopics under own workforce is health and safety. One of the impacts, an example of impacts. So let's just kind of stick over there and say own workforce, health and safety. Traditionally, when organizations used to do materiality assessments, they would typically just kind of stay over here and say own workforce, and under own workforce, health and safety is our material topic. And that's kind of really, that used to be the outcome of the materiality analysis. Of course, ESRS does not allow that. You have to go through that filter and from that health and safety angle, then go further down and understand what may be the impacts, risks, and opportunities back to the organization from health and safety. So, one of the examples that we've put in over here is potential negative impacts from exposure to substances of concern in workplace. And that is one of the examples of the outcome that is expected. When you come here, that's kind of really the type of outcome that ESRS is looking at. And then these IROs, once you've defined these IROs, you take it all the way back to the topics and you match those IROs with the topics to understand what are the disclosures under the different topics that you're going to be reporting on. So why ESRS actually puts so much of attention to that or says that you can't really go and just look at the topic and the subtopic information, it is because IROs are important. Without IROs, you cannot capture the connections back to the business of the organization. You cannot do the materiality assessment without the IROs. And in ESRS, there is a list of material IROs that are reported back into a particular disclosure that is important for your organization. Like I said, once your material IROs, and this will be a long list that will come out from your materiality analysis, when you've done that, then you tie all those IROs back to the topics from the ESRS that they belong to. From the ESRS topic, you look at the subtopic that they belong to. You may tie it back to the entity specific information, and then make sure that whatever is material from your ESRS 2 standard, you report on that in combination. So that's really in practice how you start from a topic level, go back to the IROs. But again, that process may not be static. It is generally not static. You kind of go back and forth from top to down to hybrid to combination of that, and that's absolutely possible. Just with one thing where the outcome cannot change. The outcome will always have to be clearly articulated material impacts, risks, and organizations tied back to the business model and the value chain of the organization. So this is what I wanted to share until here. I'm going to stop sharing and hand it over to Lorinda. And while I do that, and she's going to share the rest of the presentation, I just wanted to quickly remind you to keep sending your questions back to me so that I can put those questions, group them, and we can address them later. Thank you so much for your attention.
Great. So I'll pick it back up from here. What I'm going to do now is take what we just learned in an abstract way and try to put it into practice, put it into motion and bring it to life a little bit. So we have an approach, so a process that you might think about. It can be tailored for top-down, bottom-up hybrid. The one thing I will say is having done this many times, and you may have the same experience, the words have changed. Practically speaking, it's going to be interesting to see how much the double materiality on the ground actually changes for most organizations. I have my own sort of theories and thinking about why it is that some of the elements of top-down, bottom-up hybrid have been redefined. In part, it could be due to friction with assurance providers and such, but companies have always applied judgment. Companies have always used a pragmatic approach if they could. And so what we're going to do is take you through a broad approach that could be helpful, but tailor it for your own companies or your clients' circumstances. If you've been in our webinars or our classes before, you know we're fond of taking you through some of the technical details just to make it a lot more tangible and useful for you. But don't worry, we'll also kind of keep things tethered to that bigger picture. So if you do have questions as we go through, drop them in the chat, like Shivani said, and we'll get back to them toward the end. So we're going to take you through sort of a detailed ride. We always say sorry, not sorry. Hopefully it'll be helpful for you. And we'll kind of walk you through some of the steps. So what we have is we think about this sort of in four big stages when we think about the double materiality assessment, beginning with context, which is always important. From a top-down perspective, context is even more important, and we'll talk about that in a minute. But that's all the stuff surrounding the business, right? The environment that you're in, your business model, the way your company makes money, what it depends on. You can't start a materiality assessment without understanding that. Just like you would never start a strategy without understanding that piece. So we'll talk a little bit about what we mean by context before we get into things like the topics. Folks love to talk about topics. We now have a shortened list of topics that we can look at. It's used in a slightly different way in the amended ESRS. Shivani alluded to that. We'll talk you through that a little bit. That's where we actually get into those broader ESRS and entity-specific topics based on context. Okay? From there, depending on which method you use, you might go deeper or less sort of deep into the IROs to begin. But that's where we articulate what we actually need to get to, which is what are the specific impacts, risks, and opportunities that are important and material for the business. And then finally, we have to report on all of this. So don't forget that piece. Whatever it is that you're doing along kind of the A, B, and C, we need to report on. And that's also going to be assurable. So great documentation, always been important. Like Shivani said, in a fair presentation approach, probably even more important. Okay. So these are the 4 things we're going to walk through. I'll walk through each of these individually just to give a flavor of what they look like. And we'll go into some of the other changes as well that Shivani alluded to earlier in the presentation. So let's start with context. Context is critical. We always start with context. A lot of people start with a list of topics. They start with their old materiality assessment. Start with context, right? So what we want to think about here really are 2 pieces. One is how the world is changing around you, right? There are mega trends. There's geopolitical change. We know that the last year or so has been very, very uncertain, very dynamic, if you will, in terms of the world around us, right? This impacts every company in different ways. So what are the mega trends that are shaping the way that we do business in our workforce? What's the regulatory environment look like? What are the broader market and competitive forces? What are environmental trends? What are social trends, demographic trends? We don't start talking about topics and materiality in a sustainability context without understanding that world around us, right? All of those things are important, and that's really where our context needs to start. The other important piece of context is around your business strategy, right? So things like, how does your company make money sustainably over time, right? That's kind of a colloquial definition for what we mean by value creation. What's your business model? Which products and services do you sell to which companies or to which customers? What's your value chain look like, upstream, downstream? Which geographies are you in, and how might that external landscape change based on the geography you're in? And then which resources and capabilities do you rely on as a company to create value over time? So both of these things, broadly speaking, need to be included when you think about context, and they are going to shape what it is that's going to be material to your business. So it's really important to understand these pieces. It's really important to understand the implications for impacts, risks, and opportunities over the short, medium, and long term, right? This is where we start. A couple of quick examples of that and how companies might bring this to life a little bit. Value chain is one of those things that hasn't gone away in the DMA and the sort of the new ESRS 2.0. It's important to understand your value chain. Now, maybe you don't have to provide as much direct data potentially from that when you report, but you have to understand the value chain, and you have to understand the value chain and its implications for topics and impacts, risks, and opportunities. And so one example of how we might think about that, a lot of companies maybe think it's just the activities that you undertake. We really like this example here because it gets at a number of things that are important to really understand what could be material to your business. And that's really understanding a few things. One is, what activities do you undertake in getting raw materials out to your customers so that you can actually, create value for your business? What are those activities? Activities are really important in the DMA. They remain important. But it's not just about the activities. When we think about what could be material, we also have to think about the relationships that we rely on, right? Upstream suppliers, downstream customers, right? All of these are going to be really important. And then, of course, if a company produces products, there may be raw materials where you have dependencies. There may be considerations on the at end of life or how those are disposed of. So actually taking a holistic view to your value chain in terms of those activities, those relationships, those products is a really important way of thinking about, well, what is it that we need to know about our value chain? What's going to have implications for what could be material? One other thing that's important to think about too is stakeholders. So across your value chain, and there's a couple of reasons we like to have this example, but across your value chain, a lot of what we also need to be thinking about are who are the affected stakeholders of the different pieces. When we do make decisions related to our upstream business and our own operations, downstream, there are stakeholders that were affected there. And it's important still to be bringing in those affected stakeholder perspectives when we think about what's going to be material. There's different ways we can bring them in, but it's important to think about them. So in addition to thinking about activities and relationships and products, thinking about who the actors or the stakeholders are is also important. One other thing we wanted to highlight here is depending on your business, we often get asked, how far do I have to go with this value chain thing? It could be really complicated. And that's true. And so here you apply judgment. We've always applied judgment. Now there's the undue cost or effort piece, which you can use when you think about how far you map your value chain. But if you think about different types of businesses, the business we showed you here is more product focused. The business here is a financial institution, right? On the upstream side, what you have in a financial institution are things like capital and knowledge and people, right? Might be a bit simpler than maybe for other types of organizations. You have your own operations, and then you have downstream. If you're a business that's in a number of different areas that offers a number of different things, it's really important to know which parts of your business may have different enough value chains that it makes sense to map them out separately. So I work for a company that is a financial services company. We have insurance, for example. The material I's, R's, and O's that relate to property and casualty, for example, might be very different from those that focus on asset management. And if they're different enough, it's important to be able to break them up so you actually understand what's truly important downstream, right? These are some of the choices that companies make, and it's important to understand what's going to make a difference for your materiality assessment and where can you put them together. These are some of the judgment calls companies make. But as you can see here, this is a company that has a few different downstream types of businesses. They've broken out parts of their activities, products, and services and actors separately. And it probably makes some sense for how they report them on material matters, material topics, and ISRs and Os. So that's context. And as we said, from a top-down perspective, where they're explicitly saying, look, you can use your context to deduce which matters, which topics, which ISRs and Os are going to be material for you. It's really important to have a good understanding of what that looks like. Let's switch to topics, right? So once you understand your context, you understand your value chain, you understand value drivers, you understand your business model, the implications related to topics or impacts, risks, and opportunities, we talk about topics, right? So in the ESRS world, we no longer use the term matters. We use the term topics, which you've always had. As Shivani said, the list of topics that are included in the standard itself, it's gone through a couple of changes. One is it used to be a very long list of topics, subtopics, sub-subtopics. Those sub-subtopics have gone away. The topics remain, right? They're higher level. It doesn't mean we don't need to understand what those subtopics might be that could drive your material impacts, risks, and opportunities. But the list has been greatly simplified. And the role of that list has changed a little bit. It used to be a must to take that list. We called it the AR16, look at it, kind of go through and say, oh, well, this one clearly doesn't apply. This one maybe applies, and so on and so forth. It's still expected in the new ESRS that we refer to this list, right? We should consider it. It's just no longer playing the same role. But the important thing to also remember is that this has never been, even in its sort of comply or explain use, has never been the entire list of topics that companies need to consider. So referencing this list is an important part, could be an important part of your materiality assessment. But remember, this isn't it. The role of the entity-specific disclosures, if you have material topics, material impacts, risks, and opportunities not covered by these topics, you're still expected to provide those entity-specific disclosures, right? It's also why you don't just start here. Start with the context, because a good understanding of that context is going to make relatively clear when you get to this stage which other elements you may need to focus on, right? And a couple of specific entity specific disclosures or topics that we've seen pop up in the last couple of years of reporting are things like tax transparency, cybersecurity not tied, for example, to end users, right? There are a number of things that could very well be material to your company that are not going to be on this list. And remember, your goal, especially in a fair presentation environment, is to make sure the picture is complete in terms of what's material, right? And the role of those entity-specific disclosures can be even more important, especially as this list has become simplified. Right? So don't forget that. Reference this, yes, but also remember that you're telling a story tied back to your context and to what's material, and that's likely going to require additional disclosures as well. So let's look at that idea then of impact materiality and financial materiality and how we actually land on what's material. Right, that was a really quick overview of topics, and we'll circle back to it in terms of applying that materiality filter, materiality information filter. But that was just an intro to remember kind of what that universe of topics can and should look like. So let's shift to the idea of how we come up with what actually is material, right? And in a world where you can go top down, bottom up, or hybrid, The assessment could be at the IRO level. The assessment could be more qualitative at the topic level, and then you articulate those I's, R's, and O's. Whatever it is, there's a couple of things that we have to know going in. Let's start with impact materiality. One thing to understand too is we often talk about impact materiality first because it's recommended, we recommend it, it's also mentioned in the ESRS, is that you start with impact materiality. Why is that? It's because many things that are impact material could also be financially material. So it helps you with the broader view, and we'll get to that in a minute. But let's start with impact materiality. When we talk about impacts in the context of materiality, the double materiality assessment, there are four types. Right? You can see them in the quadrant here. Where do those come from? Well, an impact is defined as the impact on people and the environment. It can be positive or negative, right? So it's a good impact or it's a bad impact. And it can be actual or it can be potential. So when you pull those together, we're left with four types of impacts. And we're using similar criteria, but we apply them differently depending on what they are. It's also part of the reason it's really important to be thoughtful in how we articulate impacts, risks, and opportunities, in this case, impacts, because we're applying a different set of criteria. And whether you apply them at a very deep bottom up level or you're sort of using qualitative information to get there, it's really important to be clear about how you've applied these criteria. So let's take them one by one. If we look at actual impacts, these are impacts that are happening now. And they're positive. We look at what's called severity in the standards. That is, in this case, beneficial impact, even though severity sounds like a negative word. And there's two parts of that. One is the scale. So how beneficial is it? And then the other piece is scope. How widespread is it? So again, if it's impact on people and the environment, how big is the impact, if you will, and then how widespread is that impact? That's positive. When we get to negative, we add one feature there. We still take that same scale and scope, but we add in that element of irremediability. And this hasn't changed, by the way. It's just nice to be able to go back through it and think about now your options for assessing this. So irremediability means, can we ask the question, can we turn it back? Can we actually remediate what happened here? We're talking about things like health and safety. If that results in a grave injury or a death, that's something that's difficult to remediate, to kind of turn back to the way it was. And we need to consider that when we look at negative impacts. Okay? So these are actual positive and negative impacts. Severity applied in two different ways. And for negative, with this idea of, well, can we make it right again? Right? Can we remediate? When we get to potential, so these are things that could be impacts, maybe they aren't actual impacts. They could be at some period of time, some time horizon. We take the same approach that we take for the actual, using that severity assessment, but we assign also this idea of likelihood. So how likely is it that that impact, either positive or negative, will occur, will come to pass over whatever time frame we think is important to look at? There's a likelihood element there. We'll talk when we get to risks and opportunities, we have that likelihood piece as well. But we apply that in the potential environment. We think about which time frame it matters to think about that likelihood. One thing I will say is, and it's stated in the ESRS, is that likelihood in the negative space, let's say it's human rights, severity should take precedence, right? So maybe if it's not as widespread, if there's a huge scale of impact or a broad scope of impact, or it's not remediable, then the likelihood is less important than the severity. And companies have different ways to apply that as threshold, but that's something to keep in mind that hasn't gone away. All right, so the four types, they've got criteria for each of those types. Let's look at how that might come to life a little bit with I's, R's, and O's, what that might look like in an IRO world. So let's say we take a sustainability topic, in this case, E2 pollution, air pollution. An activity that might yield some impacts on people and environment could be the particulate emissions from our production processes. That's our own operations. We have particulate emissions that could have an impact on people or environment. How? This is where we start to define what some of these impacts could look like. Well, those could have negative health impacts in our local communities. It could lead to poor air quality in local communities. It could lead to habitat loss for native species in the area where we operate. And it could also lead, though, to new grants for research for alternative processes, right? All we've done is we've taken a topic that we believe is material, right? And we started to sketch out what those different impacts could look like. Now, to actually be able to assess those or come to a conclusion on those, we need to be able to understand, well, what type of impact is it? Because as we saw, that impacts the criteria that we use. So the first three are negative. The first two of these are happening now, they're actual. The third one, this habitat loss, that's more of maybe of a potential in the medium term of an impact. And the last one is positive, right? We can say that's a positive impact. We're giving new grants for research. We're going to benefit from that. Others may benefit from that. That's something that we're doing now. That's a potential positive. That's a positive impact. That's an. So one thing we hope you take away when you do this, whether you're doing top up or you're top down or bottom up or hybrid, is that if you have an impact, risk or opportunity, in this case, an impact, right, you should capture, if they have a different nature or a different underlying piece, you should capture them separately. If they're in a different part of your business model, your value chain, they're positive or negative, they're actual versus potential, or there's a different part of a time horizon, that could very well have real implications for whether or not that's going to be deemed material. So breaking them out to be able to understand how that may make a difference is important. I'll skip ahead a little bit and say you may not have to report them that way, or if you address them similarly, you can aggregate how you report. But to do a good materiality assessment, breaking them out when these things differ is going to be really important. A couple of things I want to clarify on some of the changes and impacts that have an implication for how we think about the materiality assessment. And I'll just go through these really quickly. For positive impacts, there's always been the notion that you can't just sort of offset a negative impact with the positive, right? That's come back. It's very explicit that if you have a negative impact, for example, negative health impacts on local communities, the things you do to remediate that particular harm, if you will, is not considered a positive impact. Okay. Things like this, the grants for research that might impact others and help them remediate their harms, that could be a positive impact. But just fixing the harm that you may have generated, that's not going to be considered positive impact. So that's back. It's been a little bit more explicit. That's an important thing to keep in mind. There's now some provision as well to be able to talk about how mitigation impacts, right? So here more on negative impacts and what that might mean. We won't go into a lot of depth here. It's actually spelled out relatively well in the standards themselves, but a few things to keep in mind. When we're talking about actual negative impacts, what we're talking about is those impacts as manifested in the reporting year based on things you've done in the past. Okay? This is a way now you can say, well, maybe that from a severity point of view, right, is no longer as high because we've mitigated it and it's been effective. Therefore, we're not going to consider that impact material. Okay? That's an option. We'll talk about what that really means here in a moment when you may not want to do that, but that's an option now that's been made explicit in the standards. Keep in mind, though, that it doesn't pertain to things you haven't done yet. It also doesn't pertain to things that you may have just started doing in the year you report. So read that carefully, but there is a provision there for that. If it's a potential negative impact, you can reflect the severity or the likelihood for things you've already implemented, not things that you're thinking about, not things that you might do later, right? But things that you've actually implemented. If you believe that changes the severity or likelihood assessment you would do, then you can reflect that in that assessment. One thing to remember is that sometimes you have remediation in place because some impact could be so material, so important that you had to put those things in place. So just remember, for example, if there's a high potential impact of forced labor in your supply chain, and that's a really important part of your value chain, right? You may still want to mention that you're addressing that, right? That might be decision useful information and what you're doing to address that and not leave it out, right? So these are things that you can apply your judgment to do, but remember, sometimes some of the elements that you're doing or why you're doing them could still be decision useful, right? Hopefully that doesn't muddy it more. I would look at the standards and see what that looks like, but now that's been expressly addressed. Hopefully that's helpful for companies going through this. A couple of other quick things. You're allowed some proxies for certain affected stakeholders. Perspectives are still very much important, but there's some very explicit ways you can get proxy information, right? That helps reduce the burden. And then some of the elements of severity have been simplified. If you know that something is going to be material from an impact perspective, you don't necessarily have to check the box on that deep assessment for each and every part of that, right? But you can go a little deeper if you need to reach a clear conclusion. So what might that look like then for those same 4 impacts that we talked about? This is just a high level qualitative view of what that could look like, just to see how the different criteria come into play. And again, to remind us how important it is to make sure those impacts are written in a way that you can actually think about them and assess them. But we've taken those same 4 impacts here, And we've applied the criteria as required in the standard, right? When it's negative and actual, you have scale, scope, and irremediability. Here we've just applied sort of a illustrative process. In our situation here, the thresholds that we've set internally, the first one would not be considered impact material, but the second one, right? And whether you get here top down or bottom up, right? Either way, kind of having some assessment of what this looks like is important. Here we have a negative potential. We applied the same thing, in this case, adding likelihood. This one in our assessment would also have been material. The last one, positive actual, we use scale and scope. The other ones don't apply, as we said. In this case, we said, no, maybe that's not risen to the idea of being potential. So again, whether you use a qualitative approach, whether you've decided at the topic level, this is important, you're just going to articulate it after the fact. Good luck with that. We'll have to really see how that looks on the ground. But this is the kind of thinking that we can do. What's really important too is that it's consistent, that it doesn't look like we're cherry picking them along the way, whatever method you use. And then, of course, you describe the process that you've taken and the conclusions that you've come to in your reporting as well. That hasn't gone away. All right. One other quick example for those of us that have been in this space for a long time, you've done lots of materiality assessments. You're used to seeing the matrix with the big terms like climate change and, workforce and things like that. This is kind of what the new world of reporting in ESRS looks like from a material impacts perspective, from a material impacts, risks, or opportunity perspective. What we can see they've done here is they've taken the topic. It's like we said, the topic that's material comes with the impacts, risks, and opportunities that are material, regardless of how you got there. So rather than sort of matrices with big topics on them, what we see is something that looks more like this, right? We have E1, which is climate change. We have different elements that they've deemed sort of important for that topic themselves, whether it's negative, when it might manifest or is manifesting, where in the value chain, a high level description of those impacts, and then a short description so you can really understand what's going on here. This is far, far more useful for users. It's also much more useful for strategy internally than just climate change. And this is part of where we want companies to get to, or we want your clients to get to. So we actually really understand what's driving this being material and how you're going to address it. So this is really where we're trying to get. Let's turn to financial materiality. The impact piece is one thing. It's really great to start. You should start with impacts first so you can kind of understand whether there's financial effects of those as well. But when we get to financial materiality, this is where we get again to the R's and O's. So impact materiality, impacts, financial materiality, risks, and opportunities. So here we're asking the question, what are the financial effects of potential risks and opportunities, or these topics, if you want to think about it that way? Where these financial effects come from, be they positive or negative, so opportunities or risks, they arise from the impacts, right? So impacts we have on the environment around us may have financial implications back for the company. Those come from impacts. Dependencies, so whether or not we can get the materials, upstream materials that we need, for example, at a price that makes sense, right? Those are dependencies. And then other context, regulation, for example. So when we sit down to think about risks and opportunities, whether they're sort of positive opportunities or risks, which are negative impacts or effects, we're thinking about what is the effect back on the company in terms of finances, which those are, be they performance, position, cost of capital, what have you. That's something that is dependent upon how your company thinks about what's important financially. We can't do this in a vacuum. If you're a sustainability leader and you're not sure how your company measures its financial performance, what's important in your financial position, assets, liabilities, for example, you can't do this well. I'll just kind of put that out there. So it's really important to be working with other folks in the organization so you really understand which financial effects you're looking at. It's also important to look back at what you report and what you say in your financial statements. If there are risks, or we have principal risks in your management report, which is where this information will live in a CSRD, ESRS world, if you haven't assessed the things that you say are principal financial risks right on the financial side of the house, you're probably missing part of that big picture, missing part of your fair presentation. So don't forget that the company's already reporting on things that says are financially risky or financial opportunities. Those often have a sustainability flavor. Make sure you're thinking about that when you set up your materiality assessment. Okay, so two things, risks, opportunities. We're always looking at the magnitude of the financial effect and the likelihood. So if we go back to the same example that we used for impacts, we're going to look at the risk side of that now. Same thing, we're looking at those particulate emissions from production processes. We're going to now look at the financial effects potentially back. Well, we could have fines to remedy the health impacts that we caused in local communities. We may have costs to remedy the air quality issues. There may be increased input prices due to ecosystem loss upstream, right? That's a dependency. And then we may actually have new revenues from product offerings with a lower pollution footprint that's a result of the grants that we finance, right? That's an opportunity. So it's important to think through these. The first two come directly from impacts. Those are usually the easiest ones to spot potentially, but there are also dependencies that we need to think about. And then there's other opportunities as well. One thing I will say is in the amended ESRS, there's even more focus on saying make sure it's clear when there's a dependency in there when you're talking about a risk, particularly that you actually highlight what those are. So again, if your risks and opportunities are coming from different places, an impact versus a dependency or some other part of the context, it's important for you strategically to know what's on critical path, like what's the driver of that. But it's also important to make sure that your materiality assessment is robust. Right? And just like with the impacts, if they're coming from different places, it's helpful to split them out so you can see if it makes a difference, right? May not have to report it that way, like we said, but it's important to understand where they're coming from. If we apply that same logic here on these same risks and opportunities, just to bring to life a little bit, and again, how quantitative or qualitative you are, how much data you gather, there's options for you. You apply your judgment here. Just remember that judgment means usually a little bit more of a look for assurance. So be buttoned up on what you capture. But let's look at those same four risks or opportunity, three risks and one opportunity. We're always looking at magnitude and likelihood. So in our example here, the first one would not be material from a financial perspective. It just has kind of a low magnitude and an even lower likelihood. The second one here, a high magnitude. So maybe there's really big costs that we expect. There's a very high or medium likelihood. That's something that, depending on how we set our thresholds, we might say is material. Same thing on the next one, right? That may hit our criteria or threshold for being considered financially material. And maybe the last one, not yet. Same process, we apply it again, make sure that we're applying them consistently. You report on the choices that you've made in your reporting, and it's important to remember that. All right, same lens, this time the risks and opportunities, same company, but we can see how they're reporting now on the risks and opportunity side. And I actually really like this because as a sustainability leader in-house, this is helpful for me, right? I mean, even kind of just knowing that climate change is important, that's great. But if you're talking to your board, you're talking to other leaders, how is climate change important, right? This is language that's actually really helpful, not just from the double materiality point of view for your reporting, but from a strategic point of view. Just look at one example because I think it's very well done. We have climate change as a standard, adaptation, like how are we responding to climate change? Kind of cut across here because this is, just some of the reasons why it's important. It's important in our own operations. What is that material risk? Well, we might face rising product prices or production costs or lower market growth, right? What does that actually really mean? Lower emissions production using raw materials with reduced carbon footprints and renewable energy increases our production costs, could ultimately also our product prices. So if we couple that with societal pressure to consume less, this could lead to lower market growth. Like that's wonderful information to understand, to really know what are we talking about climate change adaptation in terms of being a risk, you can see some down here being an opportunity, right? It's also helpful for me as a sustainability leader to go back and say, how do I address this? Should we think about re-engineering our processes up front? Should we think about finding new sources? Should we think about procurement opportunities, right? So this gives a lot more information for a user. It's also much more information strategically to be able to act on these as well. Should we communicate why it's important that we're using different raw materials, even though it's more expensive, so that we actually don't experience customer loss, for example? There's just a lot more information this delivers than just saying climate change, for example. Right. So that's where we need to get to. Again, if you get there top down, bottom up, doesn't matter. You need to be at a level where you have your impacts, risks, and opportunities, and you've applied a consistent process to them so that it's clear you're not cherry picking, so that you're kind of coming to a similar conclusion across all of the different topics, right? When you get to the end of that, you also have to report. This is the last part of our process piece. You report on the process, that's IRO 1. You report on the outcome, that's IRO 2. And one thing to mention here is those material I's, R's, and O's, that's your outcome. How you aggregate them back, those are choices that you get to make. So if you've split them all out to kind of think about testing ones you're not sure about, maybe you can put them back together, right? Depending. But you're reporting on both that process and the outcome. Not a whole lot has changed. It used to be that we reported those material ISRs and O's in an SBM disclosure. Now it's IRO2 if you're familiar with it. But a few things to consider in the process. You need to be very clear about how you've included your value chain. Now, if you've used qualitative information, quantitative thresholds, how did you apply that in determining what was material? And as I said before, that idea of the dependencies that are underlying those risks, especially, has been called out as something you need to be clear about. On the outcome side of the thing, of the house, if E1's not material, that's climate change. Before you needed to provide an explanation, that hasn't gone away. We just wanted to highlight that. But you also need to kind of talk through, well, what were these outcomes? Where are they likely to arise in our value chain in the lab, right? And if there's any changes. Again, documentation is important because you do need to report on that. And this will be part of your assurance process. So that's the process. We went through sort of the context, the topics, the ISRs and O's, starting with the impacts, and we got to the reporting. What do we do with that now? The materiality assessment is just the first part. Material information is what Shivani mentioned before. And materiality of information is now the filter for everything that we report on, even in ESRS 2. So I just wanted to bring that back really quickly, what we mean by material information. And then I'm going to apply what that might look like to to two topics, S1 and S2. So just a quick recap. If you take nothing else away about material information, one thing you need to know, material information is always in the eye of the user. Not what we want to report, not what legal wants us to report, not what we think we can get away with not reporting. Material information is in the eye of the user. Okay? What that means, this is the same content we provide before, but we need to be able to ask ourselves the question, does this piece of information provide material decision useful information about our material ISRs and O's and how we manage them? And what else would users need to know about that material information? Remember, we're in a fair presentation role, which means the story and how it hangs together matters. And the point of view of decision useful are your primary users of your general purpose financial reports, right? About providing resources to the company, right? Lending you money, right? Putting your equity on the market, for example, right? These are financial decisions, as well as other users, right? These might be people who are going to come work for your company, but it's always important to be thinking, what does a user need to know, these types of users, about our impacts, risks, and opportunities? Let's apply that to one topic here. I also want to provide a quick opportunity to show what the structure of the topics looks like. So they've also gotten a bit of a haircut and a streamlining. Most of us have reported on S1 if you've already reported. I just want to kind of bring up what it looks like, and then we'll apply the filter across S1. Now, governance and strategy specific disclosure requirements have come out of the topical standards, but don't forget where that comes into play now is you're going to be talking about governance and strategy on your material impacts, risks, and opportunities tied to your own workforce through the ESRS 2 disclosures, right? I'll show you that in a second. So it's not that they're not there, it's just that the information we provide for ESRS 2 on governance and strategy need to reflect the material impacts, risks, and opportunities that are relevant to own workforce and material to own workforce. Now we have IRO management, metrics and targets. IRO management is going to include policies, actions, in this case, engagement, right? Those GDR disclosures that we talked about, policies, actions, metrics, and targets, they come into play in how we report here. So that link is still there, and we're applying that materiality filter. That's IRO management. And then the same thing for metrics and targets. We pick the metrics and targets based on which ones are going to provide material information. And remember, we only need to provide the information that's material to our material ISRs and O's. Okay? That's important. So what does that look like in practice? I know there's a lot of words here. I'll just kind of walk us through very quickly. Take your material IRO. In this case, we have a risk, which is collective bargaining. Let's say we have a risk that says if we can't keep our labor happy, if we aren't working well enough with them, they may turn over, we may not be productive, they may leave, we may not be able to generate revenue, right? That's a risk that we've defined in our materiality assessment. How do we apply the materiality information filter? Start with the ESRS, right? How is that risk covered in our governance? Are we including this in incentives? Or is it part of our due diligence? Now, for risks, remember, it's often the underlying impact that triggers that. So think about it from that point of view. Do we have controls over our reporting when we think about this risk, right? Where does it arise in our business model? What's the process we use to get here? And what are the policies, actions, metrics, and targets? Right? That's where we start. The ESRS 2 gets that same filter. Then we go and we look at S1 itself, right? Let's look back at S1 really quickly. That'll look at this and put the same filter in there. So there are some things that are clearly going to be material information, the policies and actions that we report, the engagement channels and grievance mechanisms that we have under S1-2, employee metrics if employees are why this is material, and then collective bargaining, right? We called it collective bargaining. There's a metric called collective bargaining. Clearly, that's going to come into place. But what we want to caution you on is just the title of those metrics isn't what you're looking for here. This isn't a checkbox exercise, right? It's fair presentation. So what we're saying is you need to look at all of those other metrics and the other disclosures and say, if that provides decision useful information about how we manage this risk, in this case, collective bargaining, we should include that. So for example, wages, benefits, training, and development, they may not say collective bargaining, right? But if those are elements that might trigger issues with collective bargaining, it's probably a good idea to consider those material information included because we're telling a picture here, and that's a really important thing that we need to keep in mind. And then, of course, remember that these topics that we have here aren't always going to cover everything we need to say about how we manage that. So you should consider other information as well. Other ESRS, there's that front of each topic where we often skip over it, but it says this interacts with these standards as well. For example, in S1, it actually refers out to E1 and says if there's climate transition and that could lead to job loss, for example, then you may, if that's material, you may want to include it here. So don't forget those connection points to other ESRS. And then, of course, those entity-specific elements as well, right? Other drivers or indicators that might be related to collective bargaining to give a sense of how likely this is to occur. So that's the logic when we say applying a materiality filter, how it comes together to be able to report against something like own workforce. I know we're getting close on time, so I'll run through this one really quickly. That's one flavor of a standard. The other flavor looks a little like S2 and a few others where there are no specific metrics provided, right? Here, the task before us is to do the same thing. Think about what the impacts, risks, and opportunities are that are material, and think about, okay, well, there's no prescribed metrics. But what are the metrics that are relevant to your material ISRs and Os? For example, workers in the value chain, maybe it's forced labor and health and safety. What are the metrics that a user would need to understand for how well that's managed, right? For example, think about those dependencies. And you can also look at other types of standards to get a sense of what might make sense for those metrics. So just because they're not here doesn't mean we shouldn't be thinking about always the point of view of for our impacts, risks, and opportunities, what does a user need to know about that? And that's where you actually go and find those. So that's how we bring it to life from materiality assessment to materiality of information. A couple of things to know, and then we'll wrap it up and go to questions. There are some reliefs. I won't go through all of these, but ways to try to make the burden a little lower, right? You don't have to provide comparative data in your first year of reporting. That also includes the first year that you introduce a material topic or impact, risk, or opportunity as new. So to be aware of that. The undue cost or effort also applies to materiality assessment. It also pertains to the data that you provide. That's material, the material information. So be aware of what those look like, but no, that's not a free pass. There's an expectation that you will improve that over time. You can provide partial coverage now, or maybe you couldn't do that before. There's some elements for omissions when it's prohibited by law. You get additional time for acquisitions and divestitures. So when your company changes, you have a little more time to figure out what that means for materiality and for reporting. And there's also been some elimination for the preference of direct data in your value chain, right? Use your judgment to understand where that's most important to gather. One thing I also want to highlight is there are a number of provisions in ESRS, and the new ESRS, ESRS 1, for specific transition reliefs. Keep in mind that the ones that are listed there now are for wave 1 reporters when this comes on board. They're not yet made for wave 2 reporters. If you haven't reported yet, don't count on those necessarily being the reliefs for you. So just kind of keep that piece in mind. A few practical considerations to pull us back out of the weeds. The biggest thing also, if you take nothing else away today, IROs still matter and materiality of information matters, and that's from the point of view of the user. The other thing that matters is it looks like you have a lot of time, but remember that reporting in 2028, which is when the next wave comes online, means that you're reporting on 2027's data. which means the controls and everything else should be in place at the beginning of the year, right? That's in 11 months. It's not in many more months, right? So be thinking about that. You can't really wait until those updates are truly final. So thinking about how you're going to put the pieces in place is important. Judgment and documentation have always been important, even more important in fair presentation, where the story has to hang together. So what we would recommend from a background point of view for planning and strategy, having a clear map of those material ISRs and Os at a relatively granular level is really important and helpful for strategy. You don't have to report them that way. You can aggregate them if it makes sense and you can do it. But having them broken out is going to be really important for your planning. All disclosures go through that material IRO lens, so that materiality of information, that's important. Always consider the links back to your financial statements and risks. Don't ignore how your company's already reporting in the other part of the report. And then also think about how you're structured. There's a little bit more flexibility for structure, how that can enhance understanding. That's going to be really important too. It's not just a checklist of impacts, risks, and opportunities. We're telling a story here. It's just the story is all centered around which impacts, risks, and opportunities are material, and how are we managing those. With that, I will stop. I know that's a lot of information. I'll hand it back over to Shivani to kind of wrap us up, and we'll take some questions.
Perfect. Thank you so much, Lorinda. And indeed, everyone, thank you so much for your attention because this is a lot of information. And that's why we want to tell you how we can actually help you further. We have two upcoming masterclasses. First of all, I want to just kind of say, what is a DMA and ESRS report without connection to the strategy of the organization? So our next class is on corporate sustainability strategy. And so if you're interested in kind of understanding how you can integrate sustainability into the strategy of the organization, you're very welcome to register for this class. It's already next week. It's 10th and 11th of February. So if you're interested, keep an eye onto that. And again, we can only cover as much in an hour and a half session of a webinar on DMA, but there is so much more. There's so much behind the scenes. There's so many examples that we want to take you through. So if you're interested to take the next steps to understand how you actually implement double materiality in your organization or even refresh it when the time comes, then you can attend our double materiality class, and that's in a month's time, 10th and 11th of March. Beyond that, if you want deeper help from us, we do also have advisory services. We provide strategic support. So we're not consultants. We are traditionally a training company, but we do provide strategic support in relation to sustainability reporting standards. We focus on ESRS, IFRS, GRI, etc. And we work with both consultants as well as directly the companies who are implementing different things. And we basically provide advice on specific things like materiality assessment, stakeholder engagement, gap analysis, how to integrate or align your frameworks across the different frameworks, how to align those reports. So if you're interested in any of this, please do send us an email at learn@earthacademyglobal.com, and we'll be very happy to take you further. With that, we're going to stop the webinar content. We want to thank you again for all the great questions. We're going to try to cover whatever is possible in the remaining time. So without wasting any time, and I want to give a few minutes of breather to you, Lorinda, so I can take a couple of questions first. The first question was, we had to previously evaluate all ISROs with human rights considered and nature as a silent stakeholder. Is this still the case with the new or amended standards? So yes, that is still the case. The potential negative human rights impact, you look at the severity of those impacts. The severity of the impact takes precedence over its likelihood. So wherever human rights impacts come into picture, you do look at severity from that point of view, and it takes precedence over likelihood. That is still the case. And nature may be considered, that's what it says in ESRS 1, nature may be considered as a silent stakeholder, and there is no change from the previous version of the ESRS to the amended ESRS in this. So that thinking still kind of stays with the amended ESRS. Another question. This is about providing some insights if the DMA should be performed based on unmitigated or mitigated risks, impacts, and opportunity view. And I just want to kind of quote a few things over here from the standards. And Lorinda, if you have anything to add after that, please do. So first of all, the standards say the severity of actual negative impacts are supposed to be looked at those that manifest during the reporting year. These are those impacts that manifest during the reporting year, and they shall be assessed as they actually manifested during the reporting year. So, for those actual negative impacts, their severity is assessed based on the current reporting period, taking into account how they were mitigated in the previous reporting periods. So, when you look at remediation of impacts realized during the reporting period, that shall not be considered. Further on, they've even provided a revised definition or a follow on definition of positive impacts, where they say positive impacts include effects of the undertaking's business activities, products or services that mitigate or remediate another party's negative impacts when the undertaking is not connected to those impacts. The results of the prevention, mitigation, or remediation action to address negative impacts are not positive impacts. So that those are the few things that you do need to take care of, that you do need to recognize when it comes to kind of looking at the severity for the impacts from the point of view of mitigated versus unmitigated. And actually, a question in relation to that came, and so I grouped it together with this, and I'm going to say that out loud. Can a remediation activity be considered positive if the remediation goes beyond the immediately impacted population, that is, employees, to benefit the larger community? For example, health clinics designed to help employees overcome health impacts of working in a factory, which are also open and free to the community for general health issues unrelated to what is happening in the factory. So, again, coming back to the definitions, the remediation that you're actually tying it together with your employees may not be considered as positive impacts. But if this remediation or this action creates positive impact beyond those employees that were affected, and that's why you kind of came up with the remediation, then from my point of view, that could be an additional positive impact. And Lorinda, I don't know if there's anything to add over there.
Yeah, I think that's an important thing. I mean, I think the one thing that there's a lot of words on the page here, but I
Yeah.
think the most important thing to think about is, if you had that impact, it's negative, it's happening. The things that you've done in the past, you can use when you think about how severe is that? What's the scope? What's the scale? It would have been worse, let's say, right? So you can think about that and whether or not, however it is that you assess the severity. So when you report on that one, let's say it's positive too. Yes, you can't say, well, the remediation we did counts as positive. It doesn't. All that does is kind of count for the assessment that you do and the severity of that from a negative point of view. And if you've already done it and that's been effective, not things you're thinking about doing, which is also really important, or things you've just started doing, you also can't include those. But from a positive point of view, it's exactly what you mentioned, Shivani, which is, are there impacts that are positive beyond just the sort of making it not as bad as it could have been? But what that also means is even if you deem that to be something that is not material because the severity is low, the third piece of that is you still may want to report on what you're doing because clearly that's kind of something that you've done and you've also sort of kind of turned into a positive impact in terms of the impact beyond it. So even if it's not a material impact, you may still want to think about the policies, the actions, and all of that as something you report on because you're kind of picking up both sides of that. And that's exactly what's meant in the standard by it may still be material information, even if you've ruled out the negative side of it. Right. So there's a reason you did something on that negative impact in the first place, right? It doesn't go away. It just means that it's not as severe as it could have been.
Exactly. Great. Thanks, Lorinda. Coming back to you with another question, can you give a concrete example of the top-down hybrid and bottom-up models, please? And I know that it's not enough time to give on each, but maybe one example for maybe top-down or something.
Sure. And I'll actually say, I don't think in practice things will change that much. I mean, that's been a little bit my soapbox. I think this is a specific thing to address some very specific implementation pain points over the last couple of years. So let me just kind of put it that way. Most companies are taking a pragmatic view, but a top down view would be, and I would love to see this in practice. So if your company's done it, let me know. If you get to the right answer, you sit back and you say, we understand the context of our business well enough, how the world is changing around us, what our strategy is, the value chain. And we're going to sit back and say, based on that and what we understand about it and whatever information we want to bring in, these topics are going to be material to us. We're going to stop there. These aren't, these are. And so now we're going to go and we're going to articulate the I's, R's, and O's that might come from that. And we'll take maybe a look at them qualitatively, but we're not going to assess them individually, right? That's top down. Judgment, lots of judgment. The fact is, most companies start there anyway. You actually start saying which of these are truly in, which of these topics are truly out. Now let's go look and see what the impacts, risks, and opportunities could be, and let's think about assessing those. A bottom up would kind of potentially either start, which is the impacts, risks, and opportunities, right, and kind of bubble up. But most companies are doing something a little bit in the middle. You start with topics, rule out things that really aren't material, document, leave things in there that could be, test out some impacts, risks, and opportunities. The ones that come in, the ones that don't. That's really where most companies land. I don't think most companies are going to be doing one or the other. They're going to pick and choose the pieces that make most sense for their situation. So hopefully that helps a little bit. I would love to see one in the wild though that's truly top down because it would be sort of hard, I think, to get there without some of the bottom up or the hybrid piece as well.
Exactly. Great. Thank you so much, Lorinda. I'm just keeping an eye on the time. We do have a few more questions, but unfortunately, we don't have enough time to address those. If you continue to have questions, you're always welcome to connect with us. And we also kind of address questions in different ways in different platforms like LinkedIn and our FAQs, etc. So we will continue to do that. I would just like to on both of our behalfs, I would just like to say thank you very much for your time today. Thank you for your attention. This is a lot of information to take away in an hour and a half. So we really appreciate your time and we're here to help you further in case you need it. Thank you very much and see you next
Thanks.
time.